One rental property versus 100K in the S&P 500. The real math. Ryan puts $100,000 into a rental property. Daniel puts the exact same $100,000 into the S&P 500. Same starting money, same day, same goal. Build as much wealth as possible. Ryan believes he has the advantage because his money controls a much larger asset. Daniel believes he has the advantage because compound growth will do all the work for him. But here's where things get interesting. One of them will deal with tenants, repairs, debt, taxes, and 2 a.m. phone calls. The other could watch tens of thousands of dollars disappear from his account during a market crash without being able to do anything about it. And when we run the numbers over 20 years, the winner isn't nearly as obvious as you might think. So let's find out what actually happens when $100,000 goes into one rental property versus the S&P 500. And more importantly, let's count everything. Ryan starts with $100,000. Instead of buying a $100,000 house in cash, he uses leverage. He finds a $400,000 rental property and puts 20% down. That's $80,000. The remaining $20,000 gives him room for closing costs, initial repairs, and some emergency cash. He finances the other $320,000 with a 30-year mortgage at around 7%. His principal and interest payment is roughly $2,130 per month. Now suppose he can rent the property for $3,000 per month. At first glance, this looks fantastic. $3,000 comes in. About $2,130 goes toward the mortgage. That's a difference of roughly $870 every month. More than $10,000 a year. Ryan looks at those numbers and thinks, why would anyone put $100,000 into stocks when I can use the same money to control a $400,000 property and get paid rent every month? And honestly, that's a fair question. Because leverage is one of real estate's biggest advantages. But $870 isn't Ryan's profit. Not even close. We'll come back to that. Daniel takes his $100,000 and does something much less exciting. He puts all of it into a low-cost S&P 500 index fund. No mortgage, no tenant, no property, no keys, no rent check. He simply owns small pieces of 500 large American companies. For our example, let's assume a long-term average return of around 10% per year before inflation. That doesn't mean Daniel earns exactly 10% every year. Far from it. One year could be up 25%. Another could be down 20%. And during a major crash, his account could fall much further. But for a simplified long-term comparison, we'll use 10%. Daniel also decides to add $300 per month. Ryan doesn't laugh at him, but he definitely isn't impressed. Ryan controls a $400,000 house. Daniel has numbers on a screen. Ryan can drive past his investment. Daniel can refresh an app. Psychologically, real estate feels different. It feels real. And during the first few years, Ryan may feel like he's clearly winning. His tenant sends him $3,000 every month. Part of every mortgage payment reduces his loan balance. If the property rises in value, Ryan benefits from appreciation on the entire $400,000 house, not just his original $100,000. That's leverage at work. If the property appreciates 3% in 1 year, that's around $12,000 in additional property value. Ryan didn't invest $400,000 of his own cash, but he's getting the upside on a $400,000 asset. That's powerful. Meanwhile, Daniel's first year might look almost boring. If the market gives him a strong year, his $100,000 could become roughly $110,000 before considering his additional contributions. Nice. But nothing dramatic seems to happen. Then comes year 2. Then year 3. Daniel keeps investing his $300 every month and mostly leaves the account alone. Ryan keeps collecting rent. But now we need to look behind Ryan's $3,000 rent check. Because the mortgage is only one expense. There are property taxes, insurance, routine maintenance, vacancy, repairs, possible property management fees, and the large expenses that don't happen every month but eventually happen. A roof, an HVAC system, a water heater, plumbing, appliances, electrical work. Let's say Ryan's property taxes and insurance together cost several $1,000s per year. Then one tenant leaves. The property sits empty for a month. That's $3,000 of rent that never arrives. But Ryan's mortgage doesn't care. The payment is still due. Then the water heater fails. Another expense. A few months later, there's a plumbing problem. Another expense. Then the house needs repainting before a new tenant moves in. More money. This is where many rental property calculations become misleading. People say, my mortgage is $2,130 and my rent is $3,000, so I'm making $870 a month. No. You're collecting an $870 spread before many of your actual business expenses. A common rule of thumb is to budget around 1 to 2% of a property's value per year for maintenance, although the real number can vary widely. On a $400,000 property, even 1% is $4,000 per year, and some years could be much worse. One year Ryan might spend almost nothing. Then another year the HVAC system fails in the middle of summer. Suddenly he gets a bill for thousands of dollars. The roof won't last forever either. Neither will the appliances. These costs don't ask permission before arriving. Then there's property management. Ryan has two choices. He can pay someone else to manage the property, which can take a meaningful percentage of the monthly rent. Or he can manage it himself. If he manages it himself, he saves money. But now he has another expense that doesn't appear on his bank statement. Time. Tenant calls. Showing the property. Screening applicants. Coordinating repairs. Collecting documents. Dealing with late rent. Handling emergencies. Answering messages when he'd rather be doing something else. If Ryan spends 100 hours a year managing the property, those hours have value. Real estate can be passive, but it isn't automatically passive. And then there's the risk every landlord hopes to avoid: a bad tenant. Imagine a tenant stops paying. Ryan still owes the mortgage. He may also face legal costs, lost rent, repairs, and months of stress depending on local laws and circumstances. One bad situation can erase a large part of a year's profit. Daniel has none of these problems. But don't declare him the winner yet. Because Daniel has a different kind of nightmare. Market crashes. Imagine his $100,000 grows to $160,000. Then the market falls 35%. Suddenly that $160,000 is worth around $104,000. Years of gains can appear to disappear incredibly fast. And Daniel has to do the hardest thing in investing: nothing. He has to avoid panic. The S&P 500 has experienced brutal declines before. During the 2008 financial crisis, U.S. stocks suffered enormous losses. In early 2020, markets also fell extremely quickly. Long-term charts make crashes look like small bumps. Living through one doesn't feel like a small bump. This is where investor behavior matters. The 10% long-term assumption means very little if Daniel panics during a crash, sells near the bottom, waits until the market feels safe again, and then buys back after prices recover. The strategy only works if he can stay invested. Ryan has an interesting psychological advantage here. His house doesn't have a giant digital price above the front door updating every second. If its estimated value falls from $500,000 to $430,000, Ryan might barely notice if the tenant is still paying rent. Daniel sees his losses immediately. Real estate can hide volatility. Stocks display it on your phone. Now let's move forward. Around year 5, Ryan's property may be worth roughly $460,000 if appreciation averages around 3% per year. His mortgage balance has also fallen. His tenant has paid a large portion of the mortgage payments. That's one of the beautiful parts of rental real estate. Someone else is helping pay down debt on an asset Ryan owns. Rent may have increased too. Maybe the original $3,000 rent is now higher. But taxes and insurance may also be higher. Repairs didn't stop. Vacancies didn't disappear. So Ryan's actual cash-on-cash return may be far less impressive than the simple rent minus mortgage calculation suggested. Still, his equity is building. Daniel's account is doing something different. His $100,000 has been compounding, and his monthly contributions have been buying more shares along the way. At first, Daniel's growth mostly came from his own money. But eventually the portfolio itself starts doing more of the work. That's the magic of compounding. You earn returns. Then you earn returns on those returns. Then returns on those returns. It looks slow at first. Then the curve starts bending upward. By year 10, things get much more interesting. If Ryan's $400,000 property appreciates at an average of 3% annually, it could be worth roughly $537,000. At the same time, his mortgage balance has fallen significantly. That means Ryan could have well over $200,000 in equity, depending on the exact loan, appreciation, and costs. And that's before considering whatever net cash flow he has actually kept. Ryan has built serious wealth. But remember what came with it. A large mortgage, years of maintenance, insurance, property taxes, vacancies, tenant turnover, capital expenses, and his time. Now look at Daniel. If his $100,000 earns an average annual return of 10%, and he keeps adding $300 every month, his portfolio could be around $300,000 after 10 years, depending on the timing of returns. He didn't replace a roof. He didn't screen a tenant. He didn't call a plumber. He didn't have hundreds of thousands of dollars in mortgage debt. And he didn't have all his investment money tied to one building in one neighborhood. His money was spread across hundreds of major companies. That's diversification. But here's where the comparison becomes really interesting. Ryan used leverage. Daniel didn't. Ryan's $100,000 helped him control a $400,000 asset. Daniel's $100,000 controlled $100,000 of investments on day one. If real estate prices rise strongly, leverage can make Ryan's returns on his original cash extremely powerful. But leverage works both ways. If Ryan buys for $400,000 and the property value falls 10%, the house loses $40,000 in value. That's only a 10% decline in the property. But compared with Ryan's original cash investment, it's huge. Debt magnifies gains. Debt can also magnify losses. Now fast forward to year 20. At 3% annual appreciation, Ryan's $400,000 property could be worth around $720,000. His mortgage balance would be much lower, giving him substantial equity. Rent may also be far higher than it was when he started. And if Ryan managed the property well, controlled expenses, selected good tenants, and avoided major disasters, he could have collected meaningful cash flow along the way. On paper, that's a very successful investment. But we still have to subtract the things people love to forget. 20 years of property taxes, 20 years of insurance, vacancies, repairs, appliances, roof work, heating and cooling systems, turnover, possible management costs, buying costs, and eventually, if Ryan sells, transaction costs and potentially taxes depending on his situation. His property may be worth $720,000. That does not mean Ryan made $620,000 in clean profit. Asset value and actual profit are not the same thing. Now Daniel. If his $100,000 compounds at an average of 10% annually for 20 years, that original money alone would grow dramatically. Add his $300 monthly contributions, and his portfolio could potentially reach roughly the high $800,000 range over 20 years under a smooth 10% assumption. His actual result could be higher or lower because markets don't deliver the same return every year. But notice what happened. The boring account became enormous. And Daniel did almost nothing operationally. No mortgage, no tenant, no roof, no property manager, no vacancy. No late-night repair call. But he did have to survive market crashes without destroying his own strategy. Now change just one number. Suppose Daniel invests $500 per month instead of $300. That extra $200 doesn't sound life-changing. But over 20 years, compounded along with everything else, it can add a surprisingly large amount to his ending portfolio. That's one of the S&P 500's biggest advantages. Scaling is incredibly easy. Want to invest another $200? Transfer another $200. Want to invest another $2,000? Transfer another $2,000. Ryan can't increase his real estate exposure that easily. To scale meaningfully, he may need another down payment, another mortgage, another property, another tenant, another set of repairs, another insurance policy, another roof, potentially another 100 hours of work. But now it sounds like I'm making the S&P 500 the obvious winner. I'm not. Because real estate has advantages stocks cannot perfectly copy. First, leverage. Ryan can control a large asset using a smaller amount of his own money. Second, cash flow. A well-bought rental can produce monthly income. The S&P 500 pays dividends, but the yield alone generally isn't going to produce the same kind of monthly cash flow as a strong rental property unless the portfolio is very large. Third, control. Ryan can improve the house. He can renovate it, raise its value, improve management, find better tenants, potentially raise rents as the market changes. Daniel cannot call the CEO of an S&P 500 company and tell them how to improve the business. Fourth, taxes. Rental real estate can offer tax benefits such as depreciation and deductions for qualifying expenses. The exact benefit depends on the investor and tax rules, but it can materially change the economics. And strategies such as a 1031 exchange can allow qualifying U.S. real estate investors to defer certain capital gains taxes when exchanging investment properties under the rules. Fifth, house hacking. If someone buys a multi-unit property, lives in one part, and rents out the others, the tenants can help cover the owner's housing costs while the owner builds equity. An index fund can't give you a place to live. So when does real estate win? Real estate becomes especially interesting when you buy the right property at the right price, when rent is strong relative to the purchase price, when you understand the local market, when you budget for maintenance before things break, when you screen tenants carefully, when you treat the property like a business, and when you're comfortable using debt. A rough rule some investors look at is whether monthly rent is around 0.8% to 1% of the purchase price. That's not a universal rule, and many markets won't meet it. But stronger rent relative to price can make the cash flow equation much more attractive. Real estate can also become incredibly powerful when you add value yourself. Maybe you buy an underpriced property. Renovate it. Increase the rent. Improve operations. Or buy in an area that grows much faster than expected. Now you're not just waiting for the market. You're actively creating value. When does the S&P 500 win? When you want simplicity, when you value liquidity, when you don't want debt, when you don't want tenants, when you want instant diversification, when you can consistently invest more money, and most importantly, when you have the discipline to stay invested through terrible markets. Because Daniel's biggest enemy isn't a broken water heater, it's Daniel. If he panic sells every time the market crashes, the beautiful compound growth calculation falls apart. And Ryan has the same problem in a different form. If he buys the wrong house, underestimates repairs, overestimates rent, has no emergency fund, and assumes the property will always appreciate, leverage can turn a mediocre investment into a painful one. So who wins? One rental property? Or $100,000 in the S&P 500? The answer is less satisfying than a viral headline. It depends on the deal. A great rental property can beat the stock market. A terrible rental can destroy years of wealth. A disciplined S&P 500 investor can build a surprisingly large portfolio with almost no operational work. But an investor who panic sells can dramatically underperform the market they're trying to follow. And there's one final factor we haven't put a dollar value on: time. Suppose Ryan spends just 5 hours per month dealing with his property. That's 60 hours a year. Over 20 years, that's 1,200 hours. And 5 hours a month could be extremely conservative during difficult years. What are 1,200 hours worth? $20 an hour? $50? $100? That answer changes the comparison again. Because money isn't the only return on an investment. Your time matters. Your stress matters. Your liquidity matters. Your debt matters. And your freedom matters. Ryan may finish 20 years with a valuable property, strong equity, rental income, and an asset he can physically see. Daniel may finish with a large, liquid portfolio that required almost no maintenance. Neither strategy is automatically better. They're different machines for building wealth. Real estate uses leverage, rent, tax advantages, and active management. The S&P 500 uses diversification, liquidity, consistency, and compounding. And maybe the most interesting answer isn't choosing one at all. What happens if you use real estate for leverage and cash flow while also investing every month in the S&P 500? What happens when the rent helps buy stocks, and the stock portfolio eventually helps buy another property? That's a completely different calculation, and it might be more powerful than either strategy by itself. So the next time someone tells you real estate always beats stocks, or the S&P 500 is always the smarter investment, ask one simple question. Did you count everything? The mortgage, the appreciation, the rent, the repairs, the taxes, the vacancies, the debt, the market crashes, the contributions, the compounding, and the hours of your life. Because once you count everything, the best investment might look very different from the one that looked best at the beginning.